Hello, it's Prashant Bayani, Chief Investment Officer in Asia with BNP Paribas Wealth Management. The big topic this week, non-farm payrolls in the U.S. on Friday. They missed expectations, coming in at 266,000 jobs created versus consensus of 1 million. This very large miss, we want to caveat, first of all, there were seasonal adjustments as well as, of course, noise when you look at monthly figures. Firstly, labor market remains healthy with average hours worked increasing to 35 hours at the cycle highs. Second of all, sectors with the largest job losses saw the biggest gains in wages. In fact, workers in these sectors may be finding higher paying jobs in other sectors, or some could be leaving the workforce. Thirdly, the level of unemployment benefits could be impacting the figures. For example, industries where unemployment insurance provides 80% of more salary replacement have seen employment levels 10% below pre-COVID levels versus 3.7% for wage replacement below 80%. Finally, in addition, there's 2.8 million people who cite hesitancy to return to certain jobs post-COVID due to reopening issues, and that made a little bit more time to open as the fast-moving vaccination program rolls out through the U.S. However, very important to keep in mind, the unemployment benefits are temporary and will start to recede from September. The slowdown, at least this month, in hiring vindicates the Federal Reserve's lower for longer mantra with dual focus on average inflation targeting and full employment. In that regard, the current level of employment remains 8 million jobs below its February 2020 level. It could remain below pre-crisis employment until second half of 2020 or somewhat later. The Federal Reserve also may have a careful balancing act to observe as any, quote, transitory, unquote, pickup in wage inflation before we hit full employment, given some of the issues we covered. So what's the strategy? For financial markets, it was a Goldilocks number, extends the low-rate, easy environment policy for equities, which reacted favorably and hit new highs on the day. Also, the dollar index dropped to new lows, unwinding the yearly gains on lower employment growth. The bond market reaction was even more interesting, with the U.S. 10-year Treasury bond initially rallying by 10 basis points, but completely unwinding those movements by the end of the trading day. This raises the question, what if there had been a strong number? It is also clear the bond market looked through the monthly volatility in payroll figures, which conflict with falling jobless claims and other robust indicators. This also points to higher yields in the medium term as the economy recovers. This is in line with our view of a 2% U.S. Treasury 10-year bond yield on a 12-month basis. Thank you very much.